All right, hey, Accounting 604. This is video number 2 in Module 6. And first of all, I want to apologize for the length of our first video. That was just way too long for my liking. I just couldn't find an appropriate split point for that topic. And so we will endeavor to make the rest of the videos in this module of a more reasonable length. So we can look at the title slide now of this deck. We are looking at the disclosures to our inventory that you will typically find in the financial statement notes. Our first note we'll consider is times we will have the notation for analysis of lower of cost or market application rules. And what does this mean? It means that GAAP provides that if the market value of your inventory has dropped below its cost, whether that's FIFO, LIFO, or average, then you are required to mark down your cost of inventory down to its market value, the lower of whether it's your reported cost or the market value. So for example, let us see, you can see here that Lowe's, the hardware conglomerate with many stores across the United States, uses FIFO. And at the end of each accounting period, Lowe compares its ending FIFO value with market value or replacement cost. And if the cost is greater than its actual market value, it marks it down to the market value. It takes whichever is lower. If it's the lower of the two is the reported cost, it remains. But if the lower is actually market value, it marks it down. And it marks it down with a non-cash expense, reduction in inventory, and a reduction in gross profit, and therefore in its net income. In addition, we have mentioned in the previous deck that if you are comparing LIFO and FIFO companies, they are not directly comparable. And so we give you an actual example here. The Caterpillar company we spoke of before uses LIFO, and its foreign competitor Kubota, also a manufacturer of large construction heavy equipment, that uses FIFO because it is not a United States company, and therefore, based on IFRS rules, it has to use FIFO. LIFO is not an allowable method. You can see here the differences. And of course, some of this is obscured by the fact that Kubota, a Japanese company, reports in yen. But you can see here that there is a significant difference. For instance, look at the bolded item of inventory as a percent of total assets under LIFO versus after post-adjusting back to FIFO. Right, the level of inventory grows significantly to 23% of total assets versus the 20% under LIFO. So the reserve adjustments we need to make, we basically need to make 3 adjustments to convert LIFO to FIFO using this level of reported LIFO reserve. You know, of course, you may remember that the level of reserve is required by GAAP if you choose to use LIFO to show the adjustment back to FIFO, what that would actually do. And so you see the 3 adjustments here that you have to make that comparable to a FIFO company. You have to increase the inventory level by the amount of your LIFO reserve. You have to increase your tax liabilities by the tax rate applied to that LIFO reserve. And in other words, what would have been the appropriate level of tax the company would have paid had they used FIFO. And finally, you have to adjust retained earnings by the difference there. All right? And you see the example in Caterpillar's case for each of those kinds of things. Right? So you can see the adjustment we use to adjust LIFO to FIFO COGS, or cost of goods sold, right? And the detail here, right, that FIFO COGS will of course be lower, and this causes higher pre-tax profit, higher income tax, and higher net income. So some insights into these adjustments that might be spurred by the disclosures. You can see here that the cost flow method chosen will directly affect whether or not, as an analyst, you have cross-border comparability. You have to normalize your financials with specific consideration of inventory cost flow method before you can compare 2 companies. In addition, the LIFO reserve is the link that shows the how to make your balance sheet and income state adjustments, right? inventory, deferred taxes, retained earnings on the balance sheet, as well as, well, that's supposed to be cost of goods sold, tax expense, and net income on the income statement. All of those items will need to change and be adjusted. And finally, inventory write-downs highlight the hidden risks in your non-cash adjustments. Even though lower cost of cost or market is a non-cash adjustment, it can signal an early warning of future risk. If there is this write-down, which is not really a regular kind of an adjustment, if something has happened, it can signal some poor management decisions regarding how to keep inventory going for a particular concern. It can signal all kinds of bad things, and it basically prompts additional questions you should be asking if you notice a reported adjustment, a non-cash adjustment for lower of cost or market. Well, I hope that is useful. We've tried to keep this particular video a little bit shorter, all of this reviewed in the textbook as well. We will see you in our next video.